we have with us on the show Security Bank Chief Economist Robert Dan Roces. Good morning, sir. Thank you very much for joining us.
Good morning, Diego.
Of course, sir, the war between Hamas and Israel. Now, what kind of an impact will this have on the oil market? And are you expecting this to have a big impact?
Well, it would help if we go by historical context. So, I guess the biggest spike that we saw relative to conflicts in the Middle East actually took place in the 80s. No? So we had the Iran-Iraq war.
Okay.
That war led to price spikes of around 200%. And of course, you have Gulf War in the 90s, early 90s. Prices doubled within months. And then, the Iraq War of 2003, prices rose about 20% in the lead up to the war. So there are clear upside risks in terms of price spikes. No? However, if we put into context that situation taking place in Israel right now, early 2000, we saw, well, actually in the 80s, mid-80s, the first Palestinian uprising, it's not directly correlated with major spikes, but that added to market nervousness. And then you have the early 2000 second Palestinian uprising. So that actually contributed to a bullish market, but not directly linked to any specific spikes. So I guess, comparing what's happening in Israel versus the wider context of a larger war in the Middle East, price spikes are actually those that involve directly the oil-producing nations. So in this case, if we go by what happened in the past, there might not be a major direct influence. Effects are generally short-lived. If it's contained within Israel, and that actually depends on the scale of the conflict at any given time. When it broke out over the weekend, Monday, we saw that knee-jerk spike in terms of prices, but could traders actually anticipate no major price spike? That's what we're seeing right now. That's because of a lack of immediate supply threats. While attention actually shifts to Iran.
Okay.
What we have to closely watch out for is, if it spreads outside Israel. So oil prices jumped, but they quickly faded. That also suggests that geopolitical risks no longer has as much impact on the markets, or at least the geopolitical risk posed by what's happening in Israel.
And of course, the question on most people's minds right now is after seeing a rollback, another big rollback this week, I think this was this morning and also last night, how soon then will the Philippines feel the impact of, if there will be an impact of potential increases from, if ever, a wider Middle East conflict arises?
Well, the current conflict actually prompts portfolio rebalancing. So that will impact as well, the sentiment towards the demand for oil. So I guess it's more sentiment driven right now. I don't think it will have much of an impact so far, based on what's happening currently. But the upside risk is there. So I think we should expect those rollbacks to be, if not much smaller, I guess probably a return to an upward momentum as well. But I don't expect it to actually go up in the near term. Probably that's going to be reflected in probably 3 weeks' time.
Okay.
Given that we have to import those commodities.
And of course, sir, with the upcoming Christmas and holiday season, and we are banking on the remittances for that period to help us in our GDP growth, what now will be the effect of this war on remittances that we are expecting?
Well, remittances around 41% actually come from the U.S. And then a significant bulk of that actually comes from Saudi. So I guess it's too soon to tell, but that would depend on how wide, far-reaching the conflict will be. So if that affects Saudi, and our OFWs there get sent home, no, that will affect the levels of remittances that we will be receiving. No? So, again, it's too soon to tell. No? The hope is that it doesn't really spread outside of the borders of Israel if it comes to that.
Okay. And global inflation outlook is looking a bit dim with this conflict. Now, what can the Philippine government do to cushion at least this impact? Are there other risks that we should watch out for?
Well, the main risk that we have right now, vis-a-vis inflation locally, it's really the food inflation. It's something that we can control. So I guess that needs some fiscal complement. I mean, if oil prices do actually climb up, that's beyond our control already. There's nothing that monetary policy can do about it. So I guess it will necessitate a fiscal complement. What we have to be looking at right now in order to cushion any possible impact of oil price spikes is to actually solve food inflation in the very near term.
What's your inflation outlook for the rest of the year?
Well, we did, coming from the September spike, we had to upgrade our outlook. We came from 5.6, we're now at 6.1%. We're not expecting the target to be met already by the end of this year. Probably that's going to take place only in the first quarter.
Okay, so you're saying with all these things in place, the 7% government target is impossible?
In terms of growth, well, the best estimate will be that it reaches 6%.
Okay.
That's the lower end of the target. But yeah, with all that's happening right now, it's proving to be much harder to hit the target already.